to our investor panel. And to my left is Matt Dundon. To his left is Gary Hines in the middle. And then well, they're all my friends. And Richard Fels at the end there. And they're all senior people at their firms. Or founders. So to start the first question, I'm going to throw out to the group, and I'll start with Matt, since he's right to my left. What brings inflation down? I mean, we've got the inflation. What tools can they use to fight it? Because obviously, where inflation goes is going to impact interest, and everybody's saying that we can contain inflation. Can we? What weapons do they have?
So, as we think about that issue, the components of inflation, unemployment is the only thing that's going to reduce pressure on wages, and it's going to take a very significant amount of unemployment. Otherwise, wage pressures will continue unabated. I think anybody who is or has portfolio companies or companies well enough as an investor can tell you that the job market remains extraordinarily tight, and that pressure has to come out. I think that on the consumer goods, it's primarily an unwind of supply constraints, and I think that the base level competition in that industry is going to start to see discounting. We're going to need the Fed to continue to raise rates. I think that there'll be a bit of there's a bit of a circularity. I think the people now who are aggressively taking price are going to take their cue from policymakers, and if they see policymakers ease off, they're going to just pound right back in. And so
back in the markets and things like that.
Well, I think just to continue to take price, right? I mean, it's a psychological game. Right now, businesses that have moved aggressively on price are creating fundamentally better margins, and sometimes margins that they haven't seen kind of ever. And there's no reason why you would give that up unless you're scared. And so I think the Fed, unfortunately, if it's focused on inflation, is going to have to keep that up, and then let the other elements of the process work themselves out. But what we know is inflation is hard to fight, right? And policymakers have basically the tools they've always had. And when this economy and other developed economies went into significant inflationary cycles, I mean, they went on for the better part of a decade, right? And so pulling back on that without creating kind of catastrophic recession, it's a hard thing. And in many times, even you could significant recessions, it still wouldn't do the work, right? And that's when you go back to the 70s. So I think that as we talk to our clients and as we think about everything we're doing, we're saying significant inflation is here for a while. And even if we get a reduction in the first derivative, we're still going to be sitting at some extraordinarily elevated prices that are going to continue to change consumer behavior, right? Groceries costing what they cost now, if you're a middle income family, have become a significantly burdensome share of the monthly disposable income. And that's not going to change. In fact, that's going to create changes in how people think about whether they're buying durables and so forth. And all those things are baked in. And I mean, we're not going to get the level of deflation probably that could take those prices out. I think the basket in the supermarket to get back to 2020 prices or anywhere near close to that would take an extraordinarily level of economic distress. And so we have to think some of these behavior changes, we haven't even really started to see them, and they're going to come in and they're going to stick for a while.
So Matt, you see, I guess, so we got the 10-year rate is about 3.75. The 30-year rate is about 3.86, or call it 4 even. Do you see those going higher?
Somewhat higher. I think that the market is willing to take flat and inverted curves for a while. Certainly, a lot of people like the risk-free investments. So I think there is a strong enough demand for long-dated treasuries that we could see these curves stay flat, maybe even get significantly more inverted. Right? If the Fed a year from now is sitting at 8%, Fed funds rate, because I don't think we're going to see a 30-year at at 8%, it's probably not going to see a 30-year at 6%.
You won't see it at 4%.
Significant.
You won't see it at 4%.
Maybe you'll see it at 5%, right? But there's very different sort of supply-demand factors that are driving the price of long-dated treasuries from what's driving, government policy.
Okay. So Gary, last year at this conference, I think a few of us were more, not necessarily me, we were more excited about maintaining the low level of inflation. Do you think, in light of what Matt said, or what any of your comments, what do you think about inflation? How do we resurrect like 2020?
I don't know. And my old friend Jack Grimberg, if any of you guys remember him, he used to have these lunches. Can you all hear me, Nick? Used to have these lunches at Rockefeller Center, and he would all have these portfolio managers sitting around, and he would just go on and on how we're going to have rampant inflation because of these government deficits. Well, we didn't, for 15 years we didn't have it, even though these government deficits kept going on. And I would respond to him by saying, Jack, you're fighting yesterday's war. Something like 80% of CPI is represented by, labor costs, and labor wasn't getting any increases, and it's just not going to happen. Well, what concerns me now is they are going to start getting, and they already are getting wage increases, and I'm all for that. But that's going to bake in a fairly high inflation rate for some time. And I don't know, if you put the cart before the horse, well, we're going to jack up the rate some more. Well, we still don't get unemployment, there's more layoffs. It just, I don't know the answer, and I don't think anybody else does either.
So this morning I said that I think the Fed is in favor of creating a recession, whereas obviously the Biden administration is not. What do you think of that?
I think you're spot on. That's the only thing they know to do.
It's the only thing they know to do. But it also helps. It helps their objective, keeping rates down.
Yeah, but it's not good for labor.
Yeah, and in light of, we see it too, that the labor, the unions are starting to be a little more aggressive, getting, coming out of their 25-year slumber, and now they're trying to get some price increases. And like the bus drivers, and those railroad workers that are
Right.
Yeah, right. And so if they start getting those, there's only so much they can do. It's still a small part of the economy now, but
No, they're still a big part of CPI. Labor's still a big part of CPI.
Yeah. Richard.
So, what I think is the Fed will continue to raise rates, at least another leg and a half. And from my world, more of a trading world, I see tremendous multiple compression in the high growth companies. And so rather than having a company trading at a 30 multiple, we're now seeing companies trade at a 20 multiple. And that
Because of the higher interest rates.
because of higher interest rates, but also because of human behavior. And Matt said a lot of interesting things. We could spend all night talking about human behavior. But there are companies that have always focused on and have always survived, whether it's Walmart or Target, to consumer companies that have always traded at relatively low multiples. And consumer behavior will tend to go to those places because their prices are upward sticky. You're never going to see a huge upward trend there. The bigger issue is what happens in housing with higher interest rates and how that affects everyone here. Unions, yes, they need, the biggest problem is the cost of medical care in this country. We can fix that. That fixes a bunch of other things. So as long as rates tend to trend higher, and yes, we can stay with this inverted yield curve for a while, but over time, that yield curve will tend to point up. It's just people want to get paid for putting their money out on a duration. And it's interesting what the Fed's done because I see so many investors now doing the risk-free rate of short treasuries. And you can get 4.5% in a year or 4.60 now. A lot of people are very happy with that. So Are we going to see a recession? Well, probably not one like we've ever seen before. We're certainly not going to have food lines or not any more than what we already have. But it will be interesting in 6 months or a year how investors look at this multiple compression of the stocks that they own and how professionals will change their behavior in what they invest in.
And when you think about it, this has been the most telegraphed recession in history.
And it's still not here.
Yeah.
I mean, everyone's suffering, but we still can't call it a recession, right? It is funny, but it's not funny. It's the, so, all right, so on that point, and you might as well just finish the thought. My next question was recession or no recession next year? And I think you.
A recession like we haven't seen, we'll feel it, but it's not from the history books.
All right, but it's still a couple down quarters.
Yeah, well, we have it now.
We have that now.
Well, yeah, but we had that.
We had
third
one.
quarter apparently
We
was
had
gone.
one.
Two.
No, we had two.
Two.
Then we had one up.
One, exactly. So we're technically out of the recession, but now I'm talking about 2023 looking forward. Because,
It doesn't get any better.
it's just, Gary.
I agree. I couldn't have said it better.
Gary, it always gets better. And Matt.
I don't think we're facing serious recessionary pressures, and that actually makes me very excited as an investor because when you look across the spectrum of credit, you're getting paid a lot of yield when you're looking selectively at equities. You're getting paid a lot more return. I mean, we took that in the shorts in a bankruptcy case we're confirming, knock on wood, a couple days from now, where the market moved up the weighted average cost of capitals that to an extent that it dramatically affected where we'd be in a valuation fight with secure creditors. We're fighting on behalf of unsecured creditors, but you turn that on its head on the asset management side of my business. I'm like, boy, you see a lot of bonds and loans that appear cheap, that have enough, that have maturities in 24 and 25, and you're like, look, it's on the top of the capital structure. I'm getting paid amounts of money I haven't been paid in a long time for that risk. So with a mellow attitude towards recession, EBITDA, it's an exciting market if you have money that you can hold for a couple of years, because the basic drivers for recession, which is a withdrawal of demand, withdrawal of consumption, I don't see that. And liquidity, I think maybe we worried about it 6 months ago, but I think now people are pretty comfortable with the liquidity picture in important sides of the market. So I'm pretty optimistic.
So I agree with that concept, and I describe it a little bit differently. With higher interest rates and multiple compression, you have something called sector correlation. And a great example is if you look at the software companies that are freely trading, from the biggest to the smallest, the correlation in the software sector is approaching 1. And what that really means is that everything is moving in tandem. Everything is coming down. No one.
You mean stock price ones, right?
Stock prices.
Okay.
No one is really at this, well, people are starting to do it now, as Matt said, now it was a great opportunity to look at the companies that are well positioned, that are well capitalized, with good balance sheets. And if you buy them now, you will be, in my opinion, richly rewarded.
I do think that on the tech side, the biggest tech names are advertising driven, and to a certain extent, and the introduction of the ad-supported scale of Netflix is going to create an absolutely mammoth amount of incremental supply. So the ad sale pressure that we've seen on for Meta, the ad sale pressure that we've seen for Alphabet, that is not only continuing, but that's redoubling. And so the growth profile, what you're expecting in the future, how long it takes for the double revenue again. I mean, I think the double revenue has now probably moved out to a decade more, and double again, never, right? They're just too big a part of the economy, and there's too much advertising inventory for these companies that are so advertising driven. But when you get back to sort of B2B tech companies, if you look at a company that is far less proportionally dependent on advertising, such as Microsoft, then maybe we'll start to feel, and Apple, of course, which has a decent advertising business but doesn't really compete. Amazon has a huge advertising line but has no competition at all because it's captive advertising to buy your way up with listings. Those are some of the names where you might feel a little more comfortable you're going to get a rip back more than your Metas and your Alphabets.
So let's switch up to an international subject. The war in Ukraine, the attacks by Russia, the aggression by Russia into Ukraine, it's not called a war yet, is obviously front page news and was a key driver of this last year. Do you see a resolution sorry, you Gary, do you see a resolution of this crisis in this coming year? And what would that mean for the equity markets or even the bond markets or interest rates?
Well, it seems to me that the momentum is with the Ukrainians. And if nothing else, this whole thing has demonstrated that the emperor has no clothes in terms of the strength of the Russian military. And the fact that you had, 200,000 or 300,000 young Russian young men headed for the borders. And
they're lying today?
Yeah, but the problem is, I don't know how you deal with Putin, because I think he's surrounded himself with a bunch of yes men. He's supposedly the richest man in the world. Not that that means anything under the circumstances. But I think the Ukrainians have to keep pushing and pushing through the winter, and I've never seen people so committed and willing to live with the strictures that they're living through. It's just kind of incredible. And
maybe since the American Revolution.
Well, that's debate. That's a little bit debatable. I'm not taking the bait. I'm not taking the bait.
There's no bait.
Well, there's always bait.
I'm saying fighting for your freedom is, it's a once in a lifetime opportunity, I guess.
I think if there were a resolution, or if the Ukrainians, prevailed, I think it would be tremendous for the equity market. That's obviously a big drag, and I think that if nothing else, we learned that the Russians are going to end up having to pay a lot of money.
Do you see a Marshall Plan? Or
yes, I see something like that.
Not a retribution. I mean, asking for retribution or reparations from the Russians, we know that didn't work in World War I into World War II.
Well, we've got 300 billion of their assets frozen right now.
Yeah, okay, that's available. That's a good point. Gary? I'm sorry, Rich.
I'd love to see the Ukraine survive and thrive, both privately. There was an article last week of a wealthy Australian billionaire who committed $700 million to what he envisions to be a $20 billion rebuild fund that starts now.
20 billion? That's almost
20. Well, it's private.
No, I'm saying
need
what he
about 300
envisions.
billion.
They need about 300 billion, probably.
Correct, but this is something that he is spearheading. It's unique. It's very interesting. I'm with Gary. I would love to see a modern Marshall Plan that will get this country either back into the productivity that they've always experienced.
So we certainly think that non-North American commodity prices, right, are being hugely wedged up by the elimination of Russia from eliminating Russian participation in commodity markets. So I do think we're going to see the war over within 6 months or so, and those commodity prices will start to come in. I think that the rebuilding opportunity is interesting. Probably not as good as people think it is. I mean, Ukraine is not a first world economy. There's a lot of underlying corruption. There's a lot of EU money that's going to flow in. I would really hesitate to participate as a private investor in the reconstruction of Ukraine, where I'm competing with EU government money and probably facing some very significant corruption issues and supply issues. But I do think that we'll get a significant retreat in commodity prices. It could actually come back a little bit into the inflation picture in the U.S. maybe in the second half of 23. Overall, what we hear is that, the politicians are trying to soften Zelensky up to letting the Russians keep Crimea, and that's the trade. And that if the Russians can be told you keep Crimea, then they'll give back the Donbass and sort of mainland Ukraine will go all the way back to the Russian border. That's going to be traumatic in some respects. There's going to be very significant population moves. People fleeing back to Russia. It's not going to look great, but it probably gets done. The Russians are kind of at certain limits in capital supply chain, and there is no limit, right? And the Ukrainians have the advantage that they have unlimited resupply of material. They have another 1 million or 2 million men to go, and they have all of NATO, all of the EU, most of the rest of the world, and Russia just has its own industrial capacity and its own manpower, both of which are pretty limited.
Well, they had Iran and China there for a while.
Well, so they have Iran and China, but Iran and China are tying Putin's hands. So all Zelensky is not allowed to do is he's not allowed to bomb, Moscow and Petersburg, right? Or he's not allowed to send his special forces in to blow up, famous Russian
Well, I
landmarks.
think he wants to.
But the fact is that Xi is not letting Putin do anything. If Xi stops buying Putin's oil and commodities, he's got nothing. So who's really setting the tone of the war? It's being set in Beijing, because Beijing is telling Putin what he's allowed to do if he wants to continue to access their markets. And if they cut him off, he's gone. Within weeks.
Well, not only that, but China has only got so much capacity. You can only buy so much oil from the Russians.
Yes.
Where are you going to put it?
So they're taking it in now, but
At huge discounts, but at some point they're going to, we just can't take it. We just don't have room for it, no matter what the price is. And
Well, that's sure they have the capital to
That's
afford it.
that's bad for Russia.
But this morning we pointed out that they've stopped supporting their yuan because that takes capital too to keep the relationship
Well, then
the way you want
and
it.
there's the whole issue of what's going on in China right now.
Exactly. And that's what it says, that he's got his own problems, which no one talks about here in this country. And well, again, we had a lot of rest this morning or yesterday, and it's a cauldron, it's a boiling pot that they've kept the lid on it. But they start getting into this war in a heavy way, that lid comes and blows right off it. So I agree with Matt that the Xi has set limits on Putin, and those limits could be running out in the next few months if they haven't run out already, and they'll just get through the winter and cold, and hopefully I'd like to see some diplomacy that actually gets to a solution. So, all right, let's now transition to some specific bonds, because we all know that. I think, Matt, you showed me a list of maybe 200 bonds yesterday that you guys are following.
I think closer to 2,000.
2,000.
Right.
They're all well under par, right?
Yes.
Yeah, your traditional distress screens that a year ago might have shown 300 bonds and loans and term loans are now 2,000, 3,000, depending on how you sort of cut it between dollar price and yield discount margin. It feels pretty exciting, and then you can also look at investment grade bonds yielding 5%, right? Companies that are kind of probably existentially removed from a default that would not be driven by fraud. 5% is a lot of money to earn on a bond, right? 6% of some IG bonds that aren't that vertically elongated, so you're not taking huge convexity risk.
So let's take a look at some.
Let me just add to that. We did a quick research about a week ago on first lien and secured high yield bonds, and we under 80. There was at least 600.
600. I just want to say that a couple. Those of you who attended the 2020 conference, or at least I think that was online because it was COVID. What's my mic? You might remember a slide that said that who knew that Coca-Cola was a distressed company, and that basically the whole world was distressed at like March of 2020. So that was the story of the 2020 year, and then come 2021, we sort of had this transition of the good companies are now back to being good. Coke was back up to $60, down from 28. So you can now turn your attention to other companies in the distress market. But if we don't have capital, if we don't have new companies starting or industries evolving, we probably have a less of a supply of distress. But here we have this unusual thing. Maybe it's to Rich's unusual recession. it's exploded, and I think that's maybe why everyone's here in this room at this point, and maybe there'll be more next year, because there is so much to look at. But now let's talk about some ones with hair on it that also we picked, because everybody in the room knows of these companies. So the first one, you guys have the slides in front of you. The first one is AMC Holdings. Everybody here's been to a movie, maybe not recently, shame on all of us. And here we have the 5 7/8 bonds of November 2026. They're trading at 25. And so that means this is now going into 2023. Well, it's actually 4 years from now. So a 4-year bond that you can make 75 points on and only pay 25 points. The EBITDA, you can't read the screen up there probably, but the 9-month EBITDA is negative 7 million, which is small. Net debt is 4.5 billion, which is high. And then you got interest expense of about 250 billion, which obviously the EBITDA is not going to cover that. The equity cap is 4.2 billion. That was one of those meme stocks that rode way up. And this management did a good job by selling a lot of stock at near the peak parts. So they increased the shareholder base, took in a lot of equity capital, which they used to pay down some of their debt. Would you guys, you want to start, Rich? Would you touch that bond?
Sure. 2026 is a fulcrum year for this company. This is a relatively small deal, but there is a $1.4 billion second lien that matures in 2026. If I'm long it now, I would realize that I'm never going to get par. I might hang around and collect a couple of coupons, but I would be out.
Gary?
I agree. I think it's,
Too tough.
he's managed to pull rabbits out of a hat, but there's only so much you can do. And I think that Mr. Market is telling you, 25 today, par in a couple of years. Don't think so.
So kind of what all these bonds are showing is there's so much interesting credit you can buy at 70 cents on the dollar that feels well risk protected, that there's just an absence of demand for these stories. And I think if you can be a really intelligent credit picker in the bonds that are trading at 25 or 35, you can make some money, but part of the problem is you can only triple your money, right? You can buy, if you're going to bet that Bed Bath & Beyond is going to recover, just buy the stock, right? And the risk reward, because these bonds have the same recovery as the stock in a Bed Bath & Beyond bankruptcy or an AMC bankruptcy, zero, right?
Well, let's say Bed Bath & Beyond going from 35 to 100 is a triple, right? And you're collecting, let's say, 4%, so it's maybe 2 years, so you get maybe another, not quite a triple, but 3.5 times. So you think the stock's going to go to 15?
So if the bonds are going to recover the stock hits, right, when you think about the correlation between stock and bonds, particularly with these relatively thin layers of unsecured debt sitting on top of equity, it's not that exciting. But let's go from that general proposition to saying, okay, I'm in a world where I'm bound to I got to buy one of these bonds under 30, these unsecured bonds. What do I think about in terms of AMC? For AMC, you have a basic issue that we're not getting people back to the movies in any way that is systemically comparable to 2019. And you also have with AMC that AMC is a big and largely underinvested plan. So the things that are making people exciting about exhibitors these days are entertainment destination concepts, bowling alleys, better food, updated arcades, and AMC by and large is not set up for that, right? AMC doesn't even have, it's not fully reclining chairs around the system in the US. And so AMC and also Cineworld, which is in bankruptcy, are struggling with these very large plants that are very dependent on just packing them in with hit movies on the weekends. And there just aren't enough weekends where there are high demand movies. And as people look to the calendar for 23, we're not really seeing it.
And then you've got Netflix and streaming.
And so when we're ultimately bullish that exhibitors are going to find their way. We're going to have fewer theaters in the country, certainly fewer screens, but I think they're going to be very healthy businesses. And we've been involved in the restructuring of pretty much every movie theater chain that's gone bankrupt in the last 5 years. And a lot of them, in their reduced footprint, are kind of thriving now. And they're figuring out how to make their way with with less with less product, but AMC is not well positioned for a market that doesn't have the kind of blockbusters and have the kind of legs. And what makes me worry is we're now rolling into, we're rolling into a critical fourth quarter of the December release schedule. If Avatar underperforms, I mean, everything in the AMC cap stack and in probably some other ones is going to trade down pretty severely, because people are using that as sort of, if you can't do well with that, what are you going to do well with going forward? And we just haven't had a lot of movies this year that outperformed expectations. The only clear outperformer was Top Gun. We had a few things that performed about as expected, and a bunch of things that performed less. And we just don't have a lot more coming in 23 that people think, wow, we could have 5 or 6 outperformers. So that calendar is very hard, and for a chain that just depends on having butts and seats, and that's where they make their money, it's not great.
Thanks for that. And my view is, I would say, in response to actually the AMC. Well, let's jump to one that I think is that I've been involved in the past. It's interesting to find it back on the list. Rite Aid, one of the largest drugstore chains in the country.
I'm going to jump in just for a second so we don't miss the other ones. Bed Bath Beyond, that particular issue due in 2024, I would describe that as lender-on-lender violence. There is a group of lenders that are negotiating with the company. It's a senior unsecured piece of paper. The two other issues that trade and mature further out are trading at, let's say, $15. These guys will probably wind up owning the company through some type of rework. Beyond Meat.
So the stock of Bed Bath & Beyond will be wiped out?
Oh, yeah.
Okay. And the violence, is there anyone here in the audience who want to pick out in particular?
Committer of the violence.
Well, we keep a baseball bat under the table here. We haven't used it today.
Beyond Meat is a growth company. I think it has a reason to exist. They have one large issue, and they've actually paid down a little bit of that issue since the issuance revenue seems to be topping out last year, this year, and maybe going forward to around $450 million. If they can get over the hump, because they've spent a lot of CapEx building out, they'll survive. If not, I can imagine a large conglomerate buying them. Do these bonds, they're converts trading at $23.75, ever getting par? I doubt it.
That's in their favor, that some of this debt is converted, so they can possibly survive.
Correct.
Yeah.
And so going to Rite Aid, this is an unusual coupon. There's 185 million left outstanding. Rite Aid, over the last 5 or 6 years, have raised a lot of money in front of this particular bond. This is a legacy bond. I think it was issued in 1990 or 1997. It is a non-call bullet. And the attractiveness of this issue has always been, if it was bought by an investment grade company, this particular bond goes from 56 to some small discount where the acquirer's similar bonds would trade. And that is the sole attractiveness of this. Currently trading at 56, it's a 13.75 current yield and a 25% yield to maturity. It's possible. It's possible that you get par on this.
Before this goes bankrupt, this company, and I don't even want to use the B word with this company, even though the stock's trading at 5, it would be bought out, right? Wouldn't this be? Though I don't know who would buy it anymore, right? It's Walgreens versus Rite Aid, really.
Well, they had a deal to buy all of Rite Aid, Walgreens,
Right.
and they were only allowed to buy the southern states.
But the Federal Trade Commission stopped that.
Correct, the
Yeah.
FCC.
That is the problem.
But it could be a private deal.
Could be private deal, yeah. Yeah, you get like a SPAC, when the SPACs come back.
Probably would be.
Yeah. I don't see
I
this.
agree with Richard on this one.
So I kind of, we look at Rite Aid, we looked at Rite Aid a bunch of times over the past year as it's sort of gradually it's gradually had the air come out. And it's, to me, it's, my gut feeling is it's very attractive. It absolutely feels like it is a company that at a certain level people see the opportunity. It is hard to build that kind of retail network, and that's exactly the kind of retail network people want to own. I could see this being an acquisition target of one of the major dollar store chains. I could see a lot of private equity feeling this is right now about cheap enough for me to step in. Possibly could be tied together with some coercive exchanges, so you're not necessarily getting par, and as Rich indicated, right, a non-call bond trading at 7.7, it's now out, 5 years. That's still a meaningful amount of spread. So you can see this, you get taken out at 110, 120 if it had to get taken out. I do like it, but I always hate liking things that everyone else hates. You want to be a contrarian, but this might be one of the kind of overlooked names. Whereas I think Bed Bath & Beyond is a great example of the contrary case. It's a specific retailer that's lost its way. It has all the indicia of, go into the stores, they're messy, empty shelves, all kinds of weird things going on with promotions, clearly wrong-footed in a way that may not be possible to recover. It feels a lot like, Toys R Us felt like, or what a Kmart or Sears felt like in 2016.
And if you're afraid of being the only guy liking something everybody else hates, I might like Rite Aid too. I think it's an interesting bond. I think also we're running out of time here. So, this game. So hopefully there's some ideas here for the bankruptcy crowd that maybe AMC and Bed Bath & Beyond could be on your list because the convert bonds maybe Beyond Meat can survive, but maybe they have some time on their hands. Rite Aid is probably more for the investors in the room to keep an eye on. With that, I think we're out of time, but we can take questions if there are any. Otherwise, I guess it's capped out. Seeing no questions, I think we're done.
Thanks.
Thank you very much.
Thank you very much.